If you have a stock like NVIDIA or Palantir, obviously those have gone up a good bit more than the
We
15%,
own Palantir.
which means you have to handle them differently.
Yeah.
This podcast is for advisor use only and not to be distributed to the public. The Wealth Consulting Group is an SEC registered investment advisor, and the opinions voiced and contents in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.
All right. Welcome to this episode of The Bull of Wall Street. My name's Talley Leger. I'm the Chief Market Strategist at the Wealth Consulting Group, flying solo for us today. And this time, our special guest is Fred Meissner, President of the Fred Report. Welcome to the show, Fred.
Thank you. It's great to be here today, Talley.
Well, I got to tell a little story. In my travels at Invesco and Oppenheimer funds before the Wealth Consulting Group, I had heard your name a couple of times. This is a compliment to you from my distribution partners who liked working with you in the field too. And you know what they say, salespeople only really like to travel with analysts who get them paid. So kudos to you.
Yeah.
But going further back, I'll kind of tell another little story here. I was in Rich Bernstein and Satya Pradhuman's group at Merrill Lynch. This goes back to the 05-07 period. Is it true? I had heard, were you at Merrill Lynch as well?
Yeah, I was in the technical research department with Marianne Bartels, and Rich Bernstein ended up being director of research at that time. So I worked with Rich as well, and we had a great little department there.
Oh, it was one of the best. Yeah, I know Marianne. I've spoken at her conferences at Sanctuary Wealth in New York. So it's nice to see people kind of move on and keep doing great things. But I wanted to ask you too. I ran my own research boutique called Macrovision Research, MVR, for 5 to 6 years. So I respect your independence. How long have you been out on your own?
Talley, I've been doing this. I just realized a little while ago, I've been working at my own company, the Fred Report, longer than I worked at Merrill Lynch and at Robinson Humphrey. My first thing, I started in 2009. So I've been at this for 16 years.
That's great. That's so impressive. It's ironic, actually, because I had invited you on. I also have another reason for it, because my colleague, Jim Warden, who's our resident CMT, he was going to benefit from this conversation, but I'm sorry, he couldn't make this episode. So I got to hold down the fort for it. Is it true that you were the president of the CMT Association?
I was the president of the CMT Association right after Ralph Acampora, and I was the one responsible largely for implementing the idea of professional management, which has really expanded the association. The other thing I did, the biggest check I have ever written in my whole life ever, was when we got the CMT accepted by FINRA on par with the CFA designation, so that CMTs did not have to take the last part of the Series 87 exam, the 86-87 complex. Now, I will say one thing that I never did say in any of those meetings, but that I do think is interesting. Do you know why Series 86 is so funny?
Well, I took it. I have 86 and 87. It wasn't funny, but you give me the punchline.
Well, I didn't have to take it. I just had to take the 87.
Okay.
But what is interesting is, you know that the California Penal Code section for being drunk and disorderly and thrown out of a bar is the 86.
Okay. Well,
that's why they say you've been 86. And oddly enough, why Maxwell Smart was Agent 86.
Wow.
Yeah.
That's
So I felt it appropriate that they took the basics of fundamental analysis and called it the Series
86.
86.
Well, I know it was a common complaint, and I'm thankful that you brought that up and pushed that through. I know Ralph, by the way. I've met with him in personal. This is back in my Barclays Lehman days. We've had meetings. So, but that's really impressive. And for our audience who's unaware, or anyone who's unfamiliar, CMT stands for Chartered Market Technician. And I wanted to ask you, as a past president of the association, just for our audience who are typically financial advisors, what advice do you have for advisors considering additional certifications like the CMT or the CFA, and how can it benefit their practice?
Well, I've got a couple of things. First of all, one of the things technical analysis does better than any other analytical discipline on Wall Street is work with risk management.
Mm.
And when we're dealing with client portfolios, and in my business, the reason that a lot of very, very, very big brokerage teams have hired me, and I've got 3 of the top 10 at Merrill Lynch as clients, is to enable them to manage risk better. If you've got a stock and it's going up, that sort of problem is a good problem to have, and that sort of takes care of itself. But when things could start going wrong, having a defined strategy for risk management is helpful, and the CMT will help you do that. Talley, I should also mention, I spoke at the Academy of Certified Portfolio Managers just last week. I was in Denver. I was one of their keynote speakers along with Marianne Bartels.
Great.
And the ACPM credential, I'll send you some information on that. But for really high level portfolio management skills and techniques, that's turning into a fabulous credential.
Okay, I would love to get more information, but because you mentioned it, risk management, I wanted to key off what you're telling us here. How do you balance letting your winners run? I think you were starting to go there a little bit. On one side, with the concept of having targets and maintaining them, reallocating from year to year in your portfolios?
Sure. Well, first of all, the way I teach my clients at the Fred Report is we have 2 sets of indicators. We have indicators that are good at following trends, and we have indicators that work well in trading ranges.
Mm.
Okay. So when an indicator that works well in the trading range starts to fail and the market goes up, that's an excellent indication that what you're going to see is actually a big trending move. So you sort of switch over, there's an interplay between them, but you switch over to using that trend following indicator more. And then, of course, for risk management, there's a couple of philosophies on risk management, but I'll tell you how I generally advocate doing it. When you take your initial position in the security, I believe in using not only a technical stop point, but also a dollar amount stop point.
Okay.
Having a good technical stop point that's down 40% on the stock doesn't make a whole heck of a lot of sense when you're dealing with a customer, right? So I'll use a dollar amount stop,
Great.
even if it means taking a little bit less of a position at first, because most of the PMs I work with are adding to positions all the time in their models.
Yeah.
Right. And then after you start your move, assuming the move is successful, you can switch more to a technical stop point and a little bit less than a dollar amount stop point. If I have a profit of over 30%, I generally will not, on a stop loss, advocate letting the stock go to a negative. I will stop out near a break even and make some money.
You're locking in
especially
profits.
if I'm trading.
Gotcha.
It's important to realize that the average stock in the S&P goes up 15% a year.
Right.
Okay. Even now with the bull markets we've seen over the last few years. So if you have a stock like NVIDIA or Palantir, obviously those have gone up a good bit more than the 15%.
We own Palantir.
Which means you have to handle them differently.
Yeah.
And I have ways of showing people how to do that.
Well, that's great. So we have so much time. I wanted to come back to the indicators because that is on my agenda list. But let's kind of take a step back because I wanted to kind of get into some of the more career development background type of questions. Now, I'm a multidisciplinarian, so I do appreciate technicals, but I also cover fundamentals and behavioral considerations, quantitative analysis, the whole kit and caboodle. But what I've always respected about technical analysis is the kind of pure philosophy or belief that market prices should reflect all available information at a given point in time. And I wanted to ask you, Fred, in your 40 plus years of technical experience, how has your personal belief system evolved? And what are some of the kind of the biggest misconceptions about technical analysis that you've encountered from fundamental or even quantitative investors, other people in different buckets, and the general public?
Sure. Okay. Well, I guess when I started my career, I started out as a financial advisor with Dean Witter in Torrance, California.
Awesome.
And
Was that the
like almost
stocks and
everybody
socks?
else,
That old,
yeah,
yeah.
yeah. And I actually worked in a Sears store.
Really?
I worked
Okay.
in the Sears store at Delamo Mall. I'll never forget
I
it. It
love
was
it.
very interesting.
Yeah.
Not at all like what I do now and what I ended up doing in my last job at Merrill Lynch, but I started in a Sears store. So,
Sears Roebuck,
um,
right? Yeah.
yeah. But like all brand new advisors, I started out using fundamental analysis and really believing in fundamental
Hmm.
analysis. And I was disabused of that notion because a number of the fundamental ideas simply didn't work. So, and I'm going to just talk about equities right now and not ETFs, but I've evolved a philosophy which is very simple and easy to remember, which I'm going to tell you to your advisors.
Yeah.
Um, I believe there are good stocks and bad stocks. Okay. The trick is on the definition, right?
Yep.
The definition of a good stock for me is a stock that has a good fundamental story and is going up. Another good stock, the other kind, is a stock that has a bad fundamental story and is going down.
Mm.
A bad stock is a stock that has a good fundamental story and is going down. And a bad stock is also a stock that has a bad fundamental story but is going up anyway.
Mm.
And to me, the bad stocks are where all of your risk and reward lie.
Okay.
Okay, if you're looking for new investments, there's nothing better than having a stock that the story is terrible, management is drunk, and the stock is going up anyway.
Yeah.
Right?
Yeah.
So the trick is how to, as an investor, isolate those types of stocks and then concentrate your efforts on them for the more alpha adding part of your portfolio.
Yeah. Well, I'm glad that you brought this up because, and I'm going to kind of hinge off what you're saying here. You've noted that technical analysis kind of studies investor behavior while fundamental analysis studies companies. That's essentially what you're saying. What is the ideal balance between these two methods for building a sound investment strategy?
Well, and that to me is a good question. First of all, let's imagine a number line that goes from 0 to 100 across the screen.
Mm-hmm.
Okay. With 0 being 100% fundamental analysis and 100 being 100% technical analysis. Okay. I think every person listening to this call falls somewhere on that number line. And for me, obviously, as a technician, I'm probably a 70 on that line.
Got it.
Okay. Other people may be a 20 or a 30, but nobody is really a 0 or 100.
Mm-hmm.
Okay. You have to use your head, but what I've seen is technical analysis will warn you that something fundamental is about to change. And that to me is more important than even knowing what the fundamentals are.
Right.
As you put it, and the definition I've used is fundamental analysis is the study of companies and managements.
Mm-hmm.
Technical analysis is trading patterns and the behavior of the stock.
Right.
Right. And since one of the things I've argued about in my head with Warren Buffett is, Warren says you're buying part of a business, and that works especially well when you're buying all of the business. Right.
Yeah.
And he can do that. But most of the people listening to our conversation are buying stocks, not companies.
Right.
You want to try to buy a company that is not going down the tubes fundamentally.
Mm-hmm.
And what I do and advocate, since I work with people at all of the major brokerage firms, if I decide to put a stock on my list, say in my sector review,
Mm-hmm.
I check and make sure that the stock is either a 1 or a 2 at all the firms that I follow. In other words, a buy or a hold at all of the firms that I follow. If I have a 3 name, I'll mention it in my letter, but I won't put it on a list because my people can't buy it anyway.
Right.
Right. But you have to have some fundamental vetting mechanism. And that for me is the research department on firms. Most research analysts on the fundamental side don't know much about trading stocks.
Right.
But they at least don't buy a company and put a 1 on it and then it goes bankrupt in the next 2 weeks.
Yeah.
Right. That's extremely rare. I mean, it's probably happened, but in my career, I haven't seen it. But at the same time, little story for you. When I was at Robinson Humphrey here in Atlanta, Georgia, Robinson Humphrey at the time was the largest regional brokerage firm in the country and also a subsidiary of Smith Barney. And I downgraded WorldCom at 39. And I got a call from Jack Grubman, who was technically my superior, excoriating me for doing a downgrade on WorldCom. And frankly, he was so upset about it that I ended up calling my director of research and playing him the voicemail from Mr. Grubman and saying to Leon, Leon, I'm going to drop technical coverage of this name. There's something funny going on here. I don't like it.
Yeah.
And Leon said, we're going to drop it at Robinson Humphrey, which was hard because we had brought it public when it was LDBS Communications. We dropped it. And Grubman ended up downgrading it at 3. And I downgraded it at 39. And a lot of the Smith Barney advisors called me and said, we're not sure why we were paying him $1 million a year to downgrade it at 3.
Yeah.
Right. But the point is, if you're dealing with a client, clients are smart. People don't necessarily realize that clients are often smarter than us and better at what they do, but they don't know what we do.
Right.
Okay. But even the dumbest client will react if you say, well, the analyst really liked it at 40 and we've decided we don't like it at 3. Right. So to me, you have to avoid that. Right.
Yeah.
So technical analysis will help you that way. And of course, quantitative analysis, the only problem I have with quants, because quants are in many ways technical analysts that don't use charts.
Mm-hmm.
But quants have a tendency to go into a quantitative background and not look at the world around them. And sometimes, you've got a really good quantitative score on a steel stock, but if the market doesn't like steel stocks, the stock isn't going to work. It's not going to move.
Right.
Best quantitative score ever, but if it doesn't move, it's not what we want. So that's always been the problem I've had with the quants. And again, that sort of early warning feature of technical analysis is what has driven me to it. There are a couple of problems with technical analysis I will mention, though. One of them is the idea that every chart pattern means something. A lot of the time, the chart doesn't mean anything at all, but part of the chart does, right? There are certain patterns that have super high reliability, like head and shoulders patterns. But there's some patterns that just don't work. And a perfect example of a pattern that doesn't work is a stock that's in a high level consolidation or base that, and you guys can picture this in your heads. You've got an uptrend and the stock starts to go into a consolidation, and the consolidation goes right through the uptrend line and breaks it, and then the stock goes up. Well, the consolidation pattern didn't know that the uptrend line was there, right? That line is an artificial construct.
Right.
Right. And I've seen people that are new at this sell stocks because they go through an uptrend line when the uptrend line is artificial. I tend to use more equal sign lines than I do uptrend or downtrend lines.
That's interesting. Yeah. I mean, to some observers, I can understand how charting stocks and markets and segments can seem like a bit of a Rorschach test. And I think that really speaks to the psychology and sentiment of the observer, right? Whether they're bullish or bearish, innately, they tend to see what they want to see themselves in the chart. But I wanted to get to the market here a little bit and maybe back to some of those indicators because we've been touching on them a bit. And I'd ask you about a recession, but I know you're not an economist. But I'll tell a little story here. So I used to sit beside Jeff DeGraff, who's another recognized market technician. This is at ISI back in the glory days. I wasn't in technical research. I was doing strategy for Ed Hyman back in the day. But he told me something that always stuck to me, and it made me laugh. We were kidders, and he said that economists they kind of struck him as nothing more than technicians that are applying some of the same tools and techniques to the economic data. And I wanted to kind of do our best there with you here, Fred. Let's talk a bit about your take on Dow theory and the transports. And I wanted to ask you, does it still work in this modern economy? And maybe tell us about what are the most useful technical indicators that you see, and maybe some of the most overrated.
Sure. Well, Dow theory still works. There's always been a big problem with Dow theory, and that is that we know that the Dow Industrials and the Dow Transports have to confirm, but the theory doesn't say when they have to confirm. Okay. And that's always been a big problem for me. I tend to also look at the fact that the way the Dow Industrials and Dow Transports are constructed is very primitive, as I'm sure you know. The Dow is a price-weighted index. I talked about this at ACPM, and that means the most expensive stock in the Dow is the one that has the biggest weighting. Well, there's a reason for that, and the reason was the Dow indexes were invented in 1888.
Right.
They didn't have computers or calculators to be able to do capitalization weighting or equal weighting. One of the things that's really interesting, if you remember this, and I think you're old enough to remember this, back when I started in the late 70s, early 80s, you would always hear about the intraday high and low on the Dow. Well, it's important to realize when you go back and use Dow data from that time period that those numbers were never, ever hit, ever. The intraday high of the Dow was calculated by taking all of the high prices that the Dow 30 hit during the day, adding them up and dividing by 30, and that was the intraday high. Now, we all know that not every stock hit a high at the same time,
Right.
And the low was calculated the same way, right? That number was never hit either. I tend to use the S&P 500 and the S&P Transportation's confirming. They're better indexes, and that works. I think the fundamental idea behind Dow theory is a good one, and that is if you make goods, you have to transport them to get them to consumers.
Yes.
And if the transportation is less, that's a sign that manufacturing is slowing down, and you are essentially seeing that first in the transports.
Yeah.
Okay. And what's interesting, if you look at the current situation now, is we had a really robust economy right up until they suddenly revised all the numbers down, right? And the transports have been lagging for the last couple of years. Now, I was on the phone yesterday with a good friend of mine, Walter Murphy, who was another technical analyst at Merrill Lynch and a big data hound. This is not the longest time we've had non-confirmation on the Dow and the transports. I'm also, for those of you who are thinking of taking the CMT exam, I'm going to ask Talley a trick question. Okay. Why aren't the utilities important in Dow theory like the transports and the industrials are?
Well, I think it probably has to do with the changing nature of the US economy. Now, utilities are not behaving as a defensive sector of the market. They've morphed into a derivative of technology through power generation and AI data centers. That would be my take as a strategist.
I'll tell you the actual answer, and this is a question on the CMT. They hadn't invented the utilities when the Dow transports and were confirming the industrials and vice versa. There was no utility index. That came later.
That makes sense.
So that's why they're not part of Dow theory.
There you go.
Talley is right, by the way, that the utilities are a very safe way to play technology, and they're trading extremely well, and I just upgraded that sector. The other way to play that is, again, peripherals. One of my favorite stocks has been Trane, TT.
Okay.
They build air conditioners. Why they build all these data centers that are heat sensitive in Arizona instead of in Alaska is beyond me. But they do,
Good point.
Which means you kind of have to have the air conditioners in there.
Well, you know what they say, if you're in a gold rush, sell picks and shovels, right?
Yeah, absolutely. And that's part of that whole point. But again, a good technician will take that fundamental input, that idea, saying, hey, do we want to look at construction companies? Do we want to look at air conditioners? All the things around data centers, and then say, well, are any of those groups acting well? And the reason they may be acting well is because they have to do with the data centers and playing those stocks. Trane has been as big a winner as NVIDIA has.
Interesting. Now,
no one cares.
I wanted to ask you because, in fairness, I'll take a step back. We've been bullish on industrials since last year, and that has been a winning trade, as I'm sure you know. But this year, around Liberation Day, I think the fearmongers and the angry economists were kind of pointing to a sudden stop in activity here in the U.S., really around trucking. And maybe it'll happen, I don't know. But what I found, I took a look at it myself, and like you, I like to isolate the S&P transport segment, that group, and I found that changes in that cohort actually fit nicely with and lead corrugated box shipment growth by a handful of months. And I am a big believer in deviations from underlying trends and fundamentals. And I thought that the stocks had priced in enough bad news that they were a contrarian buy. And so far that has been a pretty good play. But what was your takeaway right here, right now? How are the transports and the industrials behaving to you?
Well, I've been overweight industrials since 2024, since the beginning of 2024. I have kept that overweight, but I did eliminate financials and I added utilities instead as an overweight. So my two overweights right now are utilities and industrials. And I think you're right at looking at some of those. One of the first things I looked at and bought when Liberation Day was announced was Walmart. And Walmart has been reacting as if these tariffs are nothing at all.
Right.
Walmart's making new highs. And I figure, I may not be right about this, Talley, but Walmart certainly should be affected by these horrible tariffs if they're going to be, in fact, horrible.
Yeah.
And they're not.
I agree. We own Walmart. We actually bought XLY as well, the kind of higher beta consumer discretionary ETF, and that has been working.
Yeah,
You know,
yeah. Again, I don't want to turn this into a discussion on tariffs because I'm really not an expert on tariffs, but I do know that all sorts of other countries have used tariffs, and those countries are still here and not doing very badly. So
that's right.
I just figured that was a bit of a thing. And, I'm amazed that the market hasn't realized that industrials are doing so well. I believe they're the number one sector
I
this
think
year.
you're absolutely right.
Yeah.
Yes.
It's either them or tech. And, one of the things I try to do in the Fred report, since I'm selling subscriptions for my technical service, and I figured probably isn't going to be a big value add if I say, golly, I like technology,
Yeah,
right? I'm trying to find different stuff.
that's right. Well, someone
Yeah.
actually pointed out to me that Chinese bank stocks have actually done better than some of these high-flying U.S. semiconductor names.
Yeah.
It's
Yeah.
amazing.
Yeah. No, the Chinese market looks to me, we got that about 6 months ago coming off the low. It gave a little buy signal, and my accumulation model on China was quite strong. So we're actually in China and still in China. I think China has started a new bull market in the face of all this stuff.
Well, so that we can go in so many directions from there, Fred. Maybe I'll just ask you. So let's talk international because we just hit on
Sure.
that. Now, I've been an early advocate of international stocks on U.S. dollar weakness since late January, early February, and that's working. Think of it like a barbell. It's tough to bet against the U.S. because of what's happening with our innovation, and you mentioned technology and the potential for tech mania 2.0 here. But what are your broader thoughts on the international category?
I won't even say I've been late to the party. International works every 10 years for a while. So I haven't been really big on international and still have not been. I've been picking some individual countries.
Mm. You
And
like
if you
China,
look at Switzerland,
Switzerland?
EWL, you'll see that when I bought that in 2010, Europe has gone sideways and that has gone up more than 2.5 times.
Mm.
And I'm still recommending Switzerland. The ETF is EWL, L as in Larry. My other two big international plays that I've been favoring for the last year and a half are Japan and India.
Okay.
I've been sort of assuming Japan and India especially India, were going to go sideways this year because they've had such big moves.
Yeah.
But those are the best technical charts out there. And again, if you look at the idea of a secular market,
Yeah.
that's secular means generational. Japan has finally made new highs last year versus 1989. There's some bank stocks there that Warren Buffett was buying that have more than doubled. Mitsubishi MUFG is one. Nomura is another one. And full disclosure, folks, I own those personally at much lower prices than here, but I do own them, and I'm planning on giving them to my kid.
Yeah.
But those have been what I've been mostly playing.
Well, before you move on, let me just cut in there for a sec. That's interesting because what you just described is kind of a conceptual barbell too. And you think of the sector composition of Switzerland and Japan. Switzerland is recognized as more of a defensive market, whereas Japan is really a play on the kind of global industrial cycle, right?
Mm-hmm. Yes. And again, one of the nice things about being a technician is I don't really have to figure out all the reasons for it. I can but the charts are impeccable.
Yeah.
Switzerland is so much better at chart than the rest of Europe is that it's not even funny for whatever reason. And Japan breaking out of a high from 1989, that's incredibly significant.
Yeah.
At least it has the potential to be incredibly significant. Plus, you look at it is a new generation over there, right? All sorts of stuff is going on. Japan has had a terrible problem with the elderly, too many old people.
That's right.
Right? Yeah. No immigration, too many elderly, and those sorts of things are changing. I think that market is going to be radically different in 20, 30 years. And in a way, I'm sad I'm probably not going to be around to see it. But there's huge opportunity there. And again, you're talking about when I bought Mitsubishi, it was $5, right? So I just bought 1,000 shares and stuck it in my IRA. It's 15 and a half, 16 now. And it could be, if it goes like JP Morgan did, it's a $300 or $400 stock.
Well, let
Right.
me ask you this. Let's connect the dots a little bit there for the audience. When it comes to global sectors, what really stands out to you now? Because your view on Japan, is it the global industrials or technology sectors? Which areas of the global markets are really kind of showing the most strength and weakness?
I think global industrials and a lot of the global financials. If you look at the ETF EUFN, which is European financials, it's performing Germany right now.
Interesting.
Yeah, there could be some real opportunity in there. So I'd be, again, a little more sector specific.
Is that defense
I
names?
spend a lot of time in,
Is
sorry?
that more of the defense names in that industrial?
Yeah,
Yeah.
defense names, things like that. They're definitely going to start building more defensive capability in Europe, and I think they should. And of course, some of that's going to be bought from U.S. defense companies, but they're going to be developing some of their own. That area is good. The banks look good, as I said. Even some of the European oils like Shell are looking pretty decent.
Well, now I have to ask about style. So, I mean, banks and energy, that kind of skews towards the value end of the spectrum. I guess industrials is kind of hard to classify, maybe kind of a bit of a blend. What would you say? Where do you come out on the style cycle? Do you prefer a little bit more of a growth at a reasonable price, or are you value guy, or does it even matter?
It doesn't matter that much to me, but what I will notice is, obviously, you don't need me here to tell you that the growth stocks in the S&P 500 have done pretty good,
Yeah.
right?
Yeah.
But if you move down the capitalization range, VBR, which is small cap value, is basically outperforming small cap growth, although growth is catching up recently, but it's also outperforming the small cap indexes as a whole. So value is winning there. Okay. And, Tally, again, discussion we had at ACPM was about market valuations, because certainly by a lot of measures, market valuations are extremely high right now. But one of the questions that I asked is, are small and mid cap valuations completely out of the range or not? I think there's real value not only in small cap value and small cap growth, and I think with the fact that the interest rates are starting to come down a little bit on the short end, that's helping.
Great.
And you're going to see a little bit more zap in there. And again, and I specialize in ETFs for my service, but one of the things I noticed was if you look at IJR, which is the main small cap benchmark, the S&P 600, you can take small cap momentum, you can add to it a satellite in DES, which is small cap dividends, get twice the dividend yield of of the main small cap ETF, and a lot more momentum and outperform.
Well, I like what I'm hearing because, and I agree, large caps have been dominant for so long, and it sounds like it's time for us to root for the little guy. What other signs are you seeing of a potentially broader market? What about the breadth indicators here?
The McClellan oscillator, which is an indicator I follow, is doing very well. My own breadth indicators are doing well. The summation index is doing well. And oddly enough, I keep a Bob Farrell indicator, the 25-day advanced decline diffusion index. And what's interesting about that index is the NASDAQ looks terrible based on that index, right? And what that is saying really is the NASDAQ is being run more and more by fewer and fewer stocks. Whereas if you look at the charts of small and mid cap, for example, They are just coming out of a very significant bottoming pattern, which is a head and shoulders bottom. Those are looking very strong there. And the last thing I will mention is I keep a sentiment indicator that's based on the American Associate, no, not the AI, Investors Intelligence.
Yeah.
Okay.
Yeah.
And the reason I use II data primarily is they have surveyed, it's a poll, it's not an actual money indicator, it's a poll, but they've been very careful to poll the same kinds of investors since 1962 when they started. If you look at the market vein data, for a while they polled options traders, then hedge fund managers, then individual investors, but they will sell you 30 years of data as if it were all the same thing. So, and the interesting thing here is my investors intelligence percent bears indicator, and I really only use the bears myself because to me, bears are the most significant people in that they will do something. Let's think about this with our clients for just a minute, Talley.
Yeah.
You've got a client who's real bullish, comes into you see in the office, says, I'm real bullish, I'm happy, let's go out for a cheeseburger, right? Or you get a client that comes in and says, I'm nervous, I think we're going to have a correction, but it's an ongoing bull market, let's go out for a cheeseburger, right? Have you ever had a client come in and say, I'm super bearish, I think the market's going to go down 40%, I'm happy with our investments, let's go out for a cheeseburger?
No.
No, you don't hear about those. Those guys don't do that, right? So I measure the bears. And what's interesting is the bears, according to my indicator, are still in more of a bearish than bullish mode, contrarian bullish.
I agree.
That indicator normally goes below 20 and stays there in a bull market.
Yeah.
It's a 24. And at the bottom in April, that indicator was higher than it was, higher meaning more bears, to be clear, higher than it was at the bottom in the pandemic.
Yeah, no.
And in one case, we were going to die.
That's one of the
and in the other,
reasons,
just going to pay more.
why I'm still bullish on this market, because we've had persistent pessimism, and I've developed my own proprietary sentiment and positioning indicator. Not a single time through this upswing since April has it turned unanimously bullish. But I like to look at a bunch of things too. I think it's important to combine the surveys, what investors are saying, with what they're actually doing. So that's a nice way to combine the two with the actual positioning. But I wanted to ask you, because you touched on the technology sector, the NASDAQ, and valuations all looking stretched. And I agree. In my conversations and travels, the word bubble has been coming up more and more, it seems. How do you reconcile the kind of wisdom of the crowd in technical analysis, and we just kind of hit on that a bit in the surveys, with the madness of the crowd that can lead to market bubbles and crashes down the road?
Well, I've lived through every single crash since '87, and one of the things about every major bubble I've seen is that when we're in it, no one says we're in it.
Right.
Okay, that's the first thing. And the second is you see certain things happen when you're in a real bubble that is going to blow up, and we're just not seeing those yet. Okay. I'll give you two examples. At my old gym in the 90s, I told everybody I did drywall for a living. And so people were kind enough to try to educate me on the stock market. And I had a guy say to me in 1999, I'm no diversifications is important, and I'm completely diversified. I own over 20 tech stocks.
Yeah.
Okay. That was the first one.
Yeah.
And, you're just not seeing that now. You're seeing more skepticism about the market being able to continue to advance. Now, I've got valuation indicators I look at, but there's one thing I've noticed about the valuation indicators. For me, there are two types of indicators. There are condition indicators and there are tactical indicators.
Right.
And valuation is a condition indicator. It's present at every major top, but it doesn't cause anything.
Right.
Right? What that means is if these tech stocks start to blow up, they're going to be able to fall an awful lot more than something like a small cap value name,
Right.
even if we have a bear market,
Yep.
cyclical bear market, right? So again, I think you have to be leery and you have to use risk management, and you have to, I think, be really, really sure of your thesis. And ideally, your thesis needs to be out of consensus.
Yeah.
Okay. For a name that's really going haywire on the upside. And again, there's one thing I learned about stop losses. And again, you're talking to an old commodity trader that basically put himself through UCLA grad school day trading S&P futures
That's
with a
awesome.
computer back in the 80s. I mean, I was putting who's who for that.
Yeah.
But you don't have to have your stop loss to stop out your entire position. You can have different stop losses at different parts of the position. Do you know how long it took me to think of that, Terry? Long enough to make me feel like an idiot, because I should have figured that out years and years and years ago.
Yeah.
Right? So you use stops to cut back on a position that's going, especially if it's a stock you want to hold longer term.
And maybe even raise your stops the better the stock does.
And of course, yeah, raise your stops. I teach the parabolic time price momentum indicator, which is a Wells Wilder indicator that's on most of the quote systems.
Yeah.
Simply because it functions as a trailing stop.
Yeah. Well, what you were saying about valuations resonates, and I agree. What I find in my work is that, and I say this all the time, valuations are not timing tools. There's literally zero statistical information between valuations now and forward returns over the next 1 to 5 years. The R squared is literally zero. It really, what the valuations do to me and my work is kind of define your structural guardrails for the really long-term forward returns. And I mean 15 years hence. So, but I wanted to ask you, because you were starting to go there, Fred, what technical signs right now would indicate the end of the current market cycle, if any? What are you watching for those?
Well, there are a few. First, and one of them, of course, is the divergence between the transports and the industrials. Okay. But no bull market is perfect. There's almost always some indicator in a bull market that isn't really up to snuff. But that one is one I'm watching. I'm watching a lot of indicators as to where stocks are closing in their ranges. If they're closing more towards the bottom ends of their ranges than the leading stocks, that's a problem. I've seen in the financials, for example, real bifurcation in some of the subsectors. A perfect example of that is look at the difference in performance between MasterCard and Visa. All of a sudden, and my old boss, Bob Robbins, said, if you're in a rowboat, y'all better be rowing in the same direction or things aren't going to work out. And one of the first signs that things aren't going to work out is that they're not all rowing in the same direction. And you're starting to see that in financials and some of the other sectors, right?
Interesting.
And that sort of thing. But I don't see anything saying that the bull market, and the last thing really, and I will talk about this just for a minute, is the bond market.
Yes.
I am of the camp that long interest rates are going to go up over the next year and not down. And I think that could be a real surprise. And I will, again, Talley, I'll try to make these charts clear without people being able to look at charts. But if you go and look at, and I'm assuming people are familiar with the interest rate indexes, TYX and TNX. But those are the 30-year bond yield and the 10-year bond yield. Okay. If you look at quarterly charts of those, what you'll see is a downtrend from the 1990s to 2022 has broken they've popped up nicely and built consolidations. That is very often a pattern that leads to further advance at the end of the consolidation. And you're seeing that on the 10-year yield and the 30-year yield. And the magic numbers for TYX are 5.2. 52 is the way they quote it. You move the decimal point over one to the left to get 5.2, and 50 or 5 on the 10-year. If you see those indexes going through those numbers, that might be enough of a surprise to really hurt the market for a few months.
Interesting. And so I assume you think that would pressure stocks through the valuation channel. But I think it's important to kind of acknowledge the earnings part of the equation too. So, I mean, I've always said that it's a good time to be involved in the stock market when earnings are growing and rising. That would be the key offset to any pressure from rates moving higher.
Yes. And the other thing about that, Talley, that I've been wondering is if that happens, that will steepen the yield curve,
right,
which is often bullish for equities.
Yeah.
Right. So having the 10-year at 7.5, which is where it would go if it broke that downtrend, might not be a bad thing.
And by the way, I think there is a little bit of confusion now in the marketplace, some head scratching around the longer end of the curve steepening or backing up here in the face of kind of potential renewed Fed rate cuts. But this is actually something that always happens when the Fed lowers the policy rate, the short end melts and the curve steepens. It's like work. In fact, it's not unusual to see a steeper in this environment. So Fred, I'm going to give you the last word. Is there anything else that we haven't, or that you'd like to opine on for our audience here?
Really, no. We've covered an awful lot. I would say, again, the main thing is really know what you're buying. If you're buying ETFs, look under the hood and see what's actually in there. So you're not like that guy in the whirlpool with me that said I'm diversified with all 30 of my tech stocks. Talley, I should mention, you probably put it out, but I am a subscription service. You can get a trial subscription at thefredreport.com. And I'd love to hear from any of your people. And Talley, of course, I'm going to send you some more information. But no, I think the naysayers are horsing around here, to make a bad joke. I don't see anything really wrong with the market until maybe the first quarter of next year.
Well, that's great to hear. And I tend to agree. So look, Fred, I want to thank you for coming on. It's been a pleasure, and hope to have you on again in a future episode.
Love to be here. And again, if I can help any of your people, please let me know.
Cheers.
Thank you.
Here's Three's company too. Come and dance on our floor. Take a step that is new.